What if your crypto could actually earn money for you while you sleep? Welcome to this explainer, where we are going to dive headfirst into the alluring, sometimes wild world of generating passive yield with your cryptocurrency. Throughout this explainer, you'll discover 5 highly realistic methods people are using right now to generate passive income with their digital assets. But, and this is a massive but, we are also going to break down the severe risks you absolutely have to understand before you even think about getting started. Here is our roadmap. We'll start with crypto passive income basics, move into staking and stablecoin yields, explore Bitcoin and tokenized assets, and then hit the heavy stuff, understanding the biggest risks, navigating the tax reality, and essential crypto security tips. Okay, let's jump right in. Section 1, Crypto Passive Income Basics. We need to set the foundation of what it actually means to put your crypto to work. So what is passive income in the crypto space? It simply means your digital assets are structurally generating interest or rewards for you over time. This is a totally different ballgame from active trading. You're not sweating over minute-by-minute charts or constantly managing buy and sell orders. The appeal is super straightforward. Instead of just letting your crypto sit totally idle in a cold wallet, basically collecting digital dust, you're setting up systems that actually put your money to work for you. Now, you might be wondering, why do crypto investors flock to these strategies in the first place? Well, just look at the contrast in returns. Traditional bank yields average a mere 0.5% APY. I mean, that's barely enough to buy a cup of coffee at the end of the year. Compare that to crypto stablecoin yields, which can offer up to 7%. You see, traditional banks keep the vast majority of the interest they make from lending out your money. But crypto platforms, they deploy your funds into DeFi or institutional markets and pass a much larger share of those profits directly back to you. It's a staggering difference, but as we'll see, that extra yield comes with extra responsibility. Moving right along to Section 2, Staking and Stablecoin Yields. Let's explore our first 2 specific methods for earning yield. Method 1 is Ethereum staking. Because Ethereum runs on a proof-of-stake mechanism rather than energy-heavy mining, you can lock up your capital to act as a network validator. In exchange for helping secure the network, you earn rewards. Simple, right? But you really have to be aware of lockup periods. Historically, as institutional timelines have tracked, assets can be tied up for a while. For example, when people staked their Ethereum around the merge in late 2022, those assets were completely illiquid for months until later network upgrades finally allowed withdrawals. Oh, and if your validator node breaks protocol rules, you face what's called slashing, which means a portion of your staked Ethereum is systematically burned as a penalty. If strict lockups aren't really your thing, method 2 is stable coin yield accounts. This involves assets like USDC, which are pegged exactly to the US dollar and backed by reserves, usually short-term US treasuries. Platforms basically generate interest by lending out your USDC. But you have to pay attention to the custody models here because they vary wildly. A decentralized DeFi platform might offer a juicy 7% using transparent on-chain lending, meaning you actually keep custody of your own keys. On the flip side, centralized finance, or CeFi platforms like Coinbase or Binance, often offer lower yields and an easier user experience, but you give up custody of your keys and take on counterparty risk. All right, Section 3, Bitcoin and tokenized assets. We're going to look at long-term strategies and the absolute bleeding edge of real-world assets. Method 3 focuses on Bitcoin long-term investing. People outside the space often think holding or hodling Bitcoin is this smooth, easy, flat bike ride straight to massive wealth. The reality? It is an emotional roller coaster. It's filled with extreme volatility, gut-wrenching drops, deep bear market valleys, and incredibly steep climbs. It is a wildly bumpy ride that requires immense psychological fortitude. So how do we actually approach that crazy volatility mathematically? Well, analysts at the Nakamoto portfolio hit the nail on the head. They note that the answer is upwards volatility, because when Bitcoin moves up, it absolutely explodes. Since a huge majority of Bitcoin's historical gains happen in very short, aggressive upside bursts, historical data shows that lump sum investing often actually outperforms dollar cost averaging. If you slowly dollar cost average, you are implicitly choosing to hold cash, which means you risk having your capital sitting safely on the sidelines exactly when those massive upward explosions happen. That brings us to methods 4 and 5, which involve real-world assets. Method 4 is crypto dividend tokens, essentially revenue-sharing tokens tied to real-world cash flows. Method 5 is tokenized treasury funds, offering a slightly lower risk crypto exposure backed by actual government bonds and institutional adoption. But how do you actually get paid your yield on these? It usually happens through 2 token mechanics. Rebasing tokens automatically increase your token balance to reflect your accrued yield.
You literally just watch the number of coins in your wallet go up. Accruing tokens, on the other hand, increase the token's overall price. Your token count stays exactly the same, but the value of each individual token goes up. Section 4. Understanding the biggest risks. Earning while you sleep sounds like a dream, but we have to take a very pragmatic look at the price of these high yields.
The golden rule of investing applies perfectly here. Higher potential returns always come with a much higher risk profile. So what are we actually dealing with? Hacks and exploits of centralized platforms where you don't hold the keys? Smart contract bugs in DeFi protocols that can literally drain funds in seconds? Malicious scams like phishing sites? Extreme price volatility that can trigger massive account liquidations? And sudden regulatory changes that can force platforms to alter their yields or just shut down overnight? You absolutely have to evaluate these risks clearly before blindly chasing a high APY. Section 5. Navigating the tax reality. Alongside risk comes another inescapable reality of earning any crypto yield. The IRS expects thorough reporting. The IRS essentially looks at your crypto activities in two distinct ways. First, capital gains. This applies when you sell, exchange, or dispose of a digital asset. If you buy Bitcoin, hold it for over a year, and sell it for a profit, that's a long-term capital gain. Second is ordinary income. If you're receiving a reward like Ethereum staking payouts or earning yield from a stablecoin savings account, that is typically taxed as ordinary income at its fair market value on the exact day you receive it. You have to maintain meticulous records because the burden of tracking the cost basis and the date of every single transaction falls entirely on your shoulders. Section 6. Essential crypto security tips. Because here's the truth. In crypto, there is no fraud department to call. Securing your assets is entirely up to you. These steps are simple, but they are absolutely critical to preventing a devastating loss. First, use hardware or cold wallets for your long-term savings, so your keys stay completely offline. Second, enable app-based two-factor authentication. Never, ever rely on SMS, as SIM-swap attacks specifically target crypto holders. Third, never store your master seed phrase digitally. No photos, no password managers, nothing. Write it on paper or stamp it into metal. Always verify full addresses before you send funds. And above all else, if a platform is promising unrealistic returns, just walk away. If it sounds too good to be true, it for sure is. We've covered a lot today. Everything from basic Ethereum staking and stablecoin yields to Bitcoin holding strategies and tokenized treasuries. But the ultimate takeaway from this explainer really boils down to one question. In crypto, you are your own bank. Are you truly prepared for the uncompromising responsibility that comes with that reward? Keep doing your own research, continue learning, and make sure you fully understand the systems before you invest a single dollar. Thanks for hanging out with us, and stay safe out there.